I mean, most of you probably heard the rule, what are the three most important things in real estate? Remember that? Everybody knows? But there's a corollary to that, and that's terms, right? Because, if Alex has something he wants to sell me, and, it's worth $1 million, and he says, well, I need $1.3 million, well, if he gets to name the price, and I get to name the terms, I could easily buy it for $1.3 million, because it depends when and how I pay the $1.3 million, right? Mm. And therein lies a lot of the magic and beauty of pre-construction sales. Because it would be interesting to, I know everybody's probably got a different opinion, but if you take the average annual rate of appreciation for Toronto real estate in the last 20 years, it's pretty significant, right? It's probably about 6-7%. But, maybe in the next 4 years it won't be quite the same. I don't know what everyone thinks, but you can do the math in your head about what you think. So what we wanted to talk about today was the two projects in Oakville, but this kind of applies to most projects. And historically, in different countries, I mean, in a lot of, in India, for example, if you buy a condominium, you pay 90% of the purchase price in installments as you go along, right? The money goes into general accounts, so it's not protected. And, it's in Miami, if you buy a condo, it's 50% deposit. In Toronto, historically, it's been 20. But because the market's a little bit challenged today, over the last couple of years, it went to 15. And there's a few isolated projects that are 10% deposit between now and occupancy. So who knows what leverage is in terms of, leverage is if you buy something, let's say for $700,000, and you have to close on it in 30, 60, 90 days, you have, you put down 20%, you get a mortgage for 80%, so that's, 4-to-1 leverage, which is pretty good. But in a pre-construction situation, if you can buy something today and get delivery in 3 or 4 years from now, price is fixed. If it's a strong seller with like a company like Mattamy, there's no risk really in terms of delivering and what you're going to buy. Also, your deposits are government insured. They're insured by the province. So the worst case scenario, maybe one out of every couple hundred projects gets canceled, right? Which is really a bad thing because people lose that appreciation that they've had because the project becomes not economic, or because the developer can't get financing, or they don't get approval in time. But the worst case scenario is you get your deposit back, which is, you can't say that for the stock market or a lot of other types of investments. So what I wanted to talk today, and hopefully we can have some questions. I'm not sure how much time we've got budgeted here, but this is a property in Oakville. The address, it's 3250 Carding Mill Crescent. It's in North Oakville. And Mattamy did a single family subdivision, and this was a piece of land left over. So it's a 5-story building with 157 suites. And Mattamy came to us about 6 or 8 months ago and said, we have a little different motivation for the next 3 or 4 or 5 quarters, in that we don't really care as much about what we make. What we do, we don't want to lay anybody off. So I said, okay, fine. But you do have a certain cost structure. You've got land costs, hard costs, soft costs, a profit requirement. You've got some givens. But let's try to craft something that's going to be very appealing. So how do you sell out a pre-construction building in a market that's a little bit challenged? We launched a project for them called Martha James in Burlington in February of 2022 when the market was really strong. The market changed about March, April, May when rates started to go up. So for a 150-unit building, we had 1,500 purchase requests. So we could have sold 10 Martha James, not just one. Today it's different. So what you have today, and a lot of people, there's really a herd effect and lemming effect in the real estate. When the market's great, everybody's buying, but when the market's not so great, fewer and fewer people are buying. But those are the times when if you have the courage and the ability to buy something, especially for a future delivery, you can really do better than if you're buying in a market that's quite steamy. So we came to them and we said, look, in pre-construction, there's a custom to have a bunch of adjustments in your contract, which is something that's not customary in resales, where if it's a one-bedroom, it might be $10,000 or $12,000 or $15,000. If it's a two-bedroom, it might be, and the development charges that the cities charge are significantly more than that, but this is just the developer's attempt to claw back and get some of that. So we said, look, if you get rid of those, just zero adjustments on those development charges. And if you include the parking, because the parking is typically priced separately. In the suburban areas, it's 40, 50, 60,000. Downtown, it's 80, 90,000. And, but the most significant thing was don't ask for 20%, don't ask for 15%, just ask for 10% deposit. So the deposit structure for this is going to launch May 3rd. Right? So also getting first pick is important too. So now you've got an insider that will get an allocation for the first offering. So it's $5,000 with the agreement, the balance up to 5% in 30 days, 2.5% of the purchase price in 60 days. Sorry, in 6 months, 180 days. And another 2.5 in 270 days. So 30 days, 6 months, 9 months. So within 9 months, you pay 10% of the deposit, and then the delivery is 3.5 years out. And these things have a tendency to not be on time because there's a lot of, but they're not going to be early, right? If anything, it's because all that really does is increase your leverage. So let me ask you, what is there a group? What do you think that the rate of appreciation would be in the next 3 to 4 years of appreciation for real estate in the city?
6%.
Okay, that's an easy one there. My math, when I do the math, you're going to see, but
Was it 5?
Yeah,
I think it's somewhere between 4 and 8%.
2? But let's just
I guess
take,
it's also
let's take the lower end of that spectrum. Let's say it's 4, right? Or even 3. Let's say it's 3, because the math really works. You can say to yourself, gee, if it works at 3, it's going to work at 4, 5, 6, 7, or 8, right? So let's say you buy something in this project for $700,000. The end prices are $550 to $850. So for a 1-bedroom, 1 plus den, 2 plus den, I don't know that there's 3s. And the parking is included, and they're going to be around $1,050 a square foot average. So you kind of do the math on what the size is. But let's say you buy something that's $700,000. So and let's assume that you put all the deposit in day one. So that's $70,000 today, and you get delivery in 3 years, maybe it'd be 3.5 or 4. So if the asset goes up at 4% per year, so that's $28,000 a year times 3, right? So basically it's about $80,000, right? So what was your deposit? $70,000. So show me. And that, I wouldn't say it's guaranteed, the old saying, if you want a guarantee, go buy a toaster, but what mutual fund or what stock can you buy where guaranteed to get, the worst case scenario is you get your money back, right? You don't lose, right? And Warren Buffett has this famous expression, there's 2 rules for investing. Rule number 1. What was it, rule number 1?
Yeah.
Don't lose money.
How about rule number 2? Anybody know rule number 2?
Don't forget rule number 1.
Don't forget rule number 1, right? So, there's a fundamental premise right there, so make sure that your capital's safe. So in buying a pre-construction condo, you've got the province of Ontario saying, you're going to give it back to you in the worst case scenario. So, but if you go through the math on that, so if it appreciates at 4% a year, never mind compounded, it's going to go up $75,000, $80,000 over a 3-year period. And your investment in the beginning is $70,000. So you've really doubled that amount of equity. So to build an estate, to make money, it's hard to get rich from a wage. Because they say, well, how does the average NBA player calculate the cost of living? Takes his income and adds 10%, right? Because people spend typically more than they make, right? So the way to build wealth is to buy things and to own things, right? And to not spend as much as you make, right? So that little pre-construction story. So this one is called Carding House, And it's by Mattamy, and it's gonna launch, I'm gonna send Alex the name of the sales manager, so if you wanna get in
I'm
on
happy
the
to share
early
that.
choices and that,
Yeah.
her name is Rose, so,
Okay.
who works with us, so
Yep.
we can do that. And then the next one, I think we had another one, was Gemini.
Yeah. If we just press there, if we press forward on the,
Forward.
if we press, just press next. Yeah, that's right.
Okay. Now this, just by coincidence, this actually happens to be in Oakville as well. Now this is a group called Castle Ridge, so it's a smaller company. They're more custom home builders, so they're a little bit more of a high-end builder rather than a production builder than Mattamy.
Yeah.
So basically, we convinced them to do the same deal, right? Because this is a little different project. It's south of the QEW, so it's in a much better location. It has a different suite mix. There's 2 buildings. They're about 100 suites each, but they're lofts. They're 2-story lofts. So that's a very interesting product, much like this little apartment here. So it's a great little setup. The price range, our Carding House Mattamy one is kind of like low 500s up to about 850. I don't think there's a unit in the building more than 875,000, right, for the suite and the parking. On this particular one, it's a totally different suite mix and sizes. So the suites they're larger and nicer, and it's a better location. So they start around 750 and go up to about $1.3 million, right? But same idea, 10% deposit, no development charges. This one, they couldn't bring themselves to give the parking for free, so the parking's gonna be $10,000. So, because we always look at every sale is it's our job to do a sale to the seller. Just like when, the real estate people have a listing, you gotta convince the seller to do what's necessary, that makes it easier for the purchaser to buy, because everybody thinks what they have is way better than what just sold next door, even though it's identical. But I have the purple curtains, right, and the new landscaping, But anyway, so I think those 2 things are very important, and obviously, I'm quite biased because we've made our whole career and a lot of our equity has grown through the ability of buying these things. And when I started selling, the first project we ever did was a long time ago on the waterfront in Toronto, and people almost laugh when they hear about it, but at the time, it felt just like it is today. It was expensive, $60 a square foot.
Wow.
The Yorkville stuff was $100 a square foot. Wow. So we just sold a building in October 21 for Pemberton called 33 Yorkville.
Yeah.
Which it was $1.6 billion sellout, 1,144 units. And again, this was in fall of 21, so the market was still quite strong. But we decided let's sell 950 units because that's all they need for construction. It's a 5 to 5.5 year delivery, so that math can work and compound longer. It was a 15% deposit, but the deposit was over almost 24 months, 18 months. And we sold those 950 units in less than a month. So the Midtown stuff is kind of like 2,000 to 2,200. We have a project in Rosedale right now that's got very large units called Seven Dale, which goes from 2,200 to 5,200 square feet. So those are 6 million to 18 million. And it's almost finished. It'll be occupying in about 90 days. And we've got 16 sold, we've got 10 left. I think that I'm obviously biased about the pre-construction thing, especially for investors, because you really don't have to worry about renting, you don't have to worry about anything pretty much from that contract until closing. So anyway, that was kind of the general part of what we wanted to cover. So I don't know, we've got some time if you want to have some questions.
Thank you so much, Hunter.
Yeah.
Really appreciate it. Anyone has any questions? Have time for a couple of questions?
Yes.
More of an example, talking about pre-construction. So I bought pre-con in 2017, the Ravine condos, York Mills, and DVP. And at the time I bought it, it was $389,000 for 630 square feet, which is pretty good price now.
Yeah.
Yeah, so
that was Urban
good.
Capital, right?
Urban Capital, yes.
Yeah, we sold that one actually.
Yeah, you did. Oh, yeah, the marketing got me too. So being a marketing guy, seeing all the terrace. But yeah, like the buying something at $389K.
So what stage is that at? Is it all closed now? Is it finished and closed?
We just got occupancy, so I'm just starting to move my stuff in.
Yeah.
Nice.
Yeah. But I mean, what the value of that suite today is like probably double, almost
Yeah,
double.
almost double, yeah. So, pretty good example of pre-cons.
Yeah, no, anything that was bought in 17 to now is really substantial. You know, we sold a project called Time and Space, which is at front in Sherburne. It's 4 towers, 1,600 units for Pemberton. And that was, the early phases were around $700-800 a square foot, and the later phases were around $800 or $900 a square foot. So those, you know, if a new project comes out in that neighborhood today, it's probably $1,600 or $1,700 a square foot.
Wow.
Listen.
So, if you place a deposit for a specific purchase price, and like 3 years into the future, it either like price goes up or price goes down, are you set with that initial price, or does it fluctuate?
Yeah, no, it's an agreement, you know, our lawyer friends can explain, you know, the contract is a contract, so, you know, I mean, it's the same with resales, like if you buy something and it closes at a certain point in time, it's a contract, so, you know, you're bound, and so is the developer.
So if it goes down, there's no room to negotiate? price?
Well, listen, I wouldn't say, I mean, not necessarily, I mean, you know, right now, I mean, we've got some situations where if you have a project that is, we had a project out on the Danforth that a previous builder went into receivership, a new builder bought it and started it, so the time that went from selling to closing was about 18 months. It was called Danforth. It was Danforth in Maine, let's say, right? So it's sold in a fairly strong period of time, and it's closing in a period of time that's, you know, so I don't know, I don't think the prices are down, but I don't think they went up and then they came back down again, right? In that 18 months. So there's really no appreciation to speak of in that example, but that's really quite an exception, just because usually those delivery dates are a minimum of 36 to 42 months. Right?
All right. Well, thank you so much. This was
Okay, guys.
great.